Companies went public last year. What are the numbers you're looking at for this year?
Well, here's the thing. The IPO market runs parallel with the stock market. So we expect that there's going to be a bunch of folks wanting to get money now in the new year. So we think it's going to be a boon.
A boon? Can you give me a number?
Listen, I don't know. Maybe between 25 and 35, it'll be good.
And you're talking about tech-related IPOs specifically?
That's correct, yes. Yep.
Okay. So any companies in particular that you're looking at? We've heard that Airbnb, Dropbox, GoPro, Uber could all go public this year.
They might. Well, there's one that you mentioned previously, Alibaba. I mean, they actually have, some good things. They have revenue growth, but they have profitability. So we kind of hope they go public, because if you look at some of the companies that went public last year, they weren't necessarily dogs, but they didn't have fundamental performance at all. So we believe they were overinflated on the value side, Emily. So hopefully some good companies will go public where they can actually justify the valuation.
When you say good, what do you mean? How do you define a good company, a good investment?
Okay. Right, that's good. The old-fashioned way. They've got revenue growth, they've got positive cash flow, they have profits, they've got profit margins, they've got a good market, and last, and very importantly, if you look at the IPOs from 2013, they are valued within the realm of the universe, meaning they're not so overinflated that people who come in can get a good value, or at least a reasonable value.
Now, Twitter doesn't have a profit. They do, however, make money.
Yep.
Does Twitter not count as good?
Well, you know what? In a bull market, everyone looks smart. So I'm going to dodge that question a little bit. But here's the thing with Twitter. They came out at 98 times trailing revenue. In order for them to justify just their IPO price, they'd have to generate 70% sales growth for 10 years with very high profitability, and they're actually still losing money. So I'm not saying the company's bad, but if you look at the way you should value companies, which is, cash flow in the future discounted to today, they are way overvalued even today. So if you got in at 26 and you're at 57, you look really smart. But I would largely say that's attributable to the bull market, not to their performance.
Now, Twitter has lost actually 17% of its value, the market cap value, in just the last week. This is, $9 billion plus of market cap wiped out since their high in December. Where do you see Twitter settling?
I don't know, and I don't want to evade that question, but I got to tell you, not to be a cynic, but I was shocked at where they went out when they went public, never mind where they are right now. It's really amazing. Now, remember, the music is going, and people are in their chairs, they're running around when they are going public, but when the music stops and the economy slows down, which it always does, the real risk is when that happens, those companies tend to plummet in value. Now, I don't want to say that's going to happen, but valuation is very important, and I see Wall Street being a little greedy on the price. There's absolutely no question about that. So I don't know if that trend will keep going down, Emily, but really they're still overpriced, at least according, to me.